Okay, in the dividend growth model, where does G come from? Where does the growth rate come from? And can we extract it? Can we extract the future growth rate, or can we infer what the future growth rate of a stock be by looking at the company's balance sheet or income statement? So where does G come from? We will go step by step. So first, definition of earnings per share. So earnings per share is earnings at time t. Okay, total earnings at time t, net income at time t, divided by the number of shares outstanding. Once earnings per share are realized, where do they go? So a company may use some or all of its earnings to pay dividends, or a company may reinvest some or all of its earnings. And we will call the reinvested earnings as retained earnings. So let P denote the dividend payout ratio. So small p, payout ratio, which is the fraction of earnings which will be paid to shareholders as dividends. So if a fraction p of earnings are paid to shareholders as dividends, then we can divide earnings at time t in two. Okay, so we have P times ET, dividends, and 1 minus P times ET, retained earnings. Simple. Okay, P times ET, dividends, 1 minus P times ET, retained earnings. So the retained earnings, 1 minus PET, are allocated to new investments. These new investments will produce a return that we will call the return on new investments, RN. So the dollar return on new investments is RN times retained earnings. And the dollar return on new investments will increase the following year's earnings compared to the current year. So next year's earnings would be exactly the same as this year's earnings if without new investments. But if some of these earnings are retained, invested, and produce a cash flow RN times whatever has been invested in new projects, well, the earnings at time t plus 1 are equal to the earnings at time t plus the return on new investments. If we rearrange this equation, so ET plus 1 minus ET is equal to retained earnings times the return on new investments. If we divide by both sides of this equation by ET, we obtain ET plus 1 minus ET over ET is equal to 1 minus P times RN. So the retention rate times the return on new investment gives the growth rate in earnings. So growth rate in earnings that we just developed is equal to the retention rate is 1 minus the payout ratio. So a fraction of earnings are paid out as dividends, and the other fraction is retained in the firm. So the fraction retained in the firm, we call it the retention ratio, which is equal to 1 minus the payout ratio. So 1 minus the payout ratio times the return on new investments gives us the growth rate in earnings. Now, if the payout ratio is constant, if the fraction of earnings paid as dividends always remains the same, the growth rate in dividends has to be equal to the growth rate in earnings. So if I develop my equation for the growth rate in dividends, so the growth rate in dividends is dividend at time t plus 1 minus dividend at time t divided by dividend at time t. So dividend is equal to P times E at times t plus 1 minus P E at times t divided by P times E at times t. So all the P, so P multiplies every variables in this fraction. So the P's cancel one another. So the growth rate in dividend is equal to the retention ratio times the return on new investments. So the growth rate in dividends is equal to 1 minus the payout ratio times return on new investments. Okay, so G, the growth rate is equal to the retention rate times the return on new investment. It's equal to 1 minus the payout rate times the return on new investment. It's 1 minus P times Rn. Payout rate P, return on new investments Rn. Example, ABC Inc. expects earnings per share of $3.50 at the end of this year, from which it intends to pay a dividend per share of 70 cents. Earnings not paid out as dividends will be reinvested in projects expected to earn an annual return of 4.4%. If ABC's cost of equity capital is 10.2%, what should its current stock price be? First, compute the dividend payout ratio. P is D1 over E1, 70 cents over $3.50, 20%. Return on new investment, 4.4%. Expected growth rate, 1 minus the payout ratio times return on new investment. So 1 minus 20% times 4.4%, 3.52%. So the price is next year's dividend over equity cost of capital minus expected growth rate. So 70 cents divided by 10.2% minus 3.52%, which gives $10.48. Another example, ABC Inc. expects earnings per share of $2.50 at the end of this year, from which it was intending to pay a dividend per share of $1.20. Earnings not paid out as dividends are reinvested in projects expected to earn an annual return of 5.6%. Suppose ABC changes its dividend policy and decides to cut next year's dividend to 60 cents. So instead of paying $2.50 as dividends, the company will pay 60 cents as dividends, reinvesting the rest of its earnings in projects still expected to earn 5.6% annually. If ABC's cost of equity capital is 9.6%, what is the impact of this change in dividend policy on the company's stock price? First, we need to compute the stock price with the initial dividend policy. So we have a dividend payout ratio at the start of $1.20 over $2.50, so 48%. So at the beginning, the company was expected to pay, I made a mistake earlier. I said 0.60 instead of 250, so it's 0.60 instead of 120, but it doesn't matter. So the initial payout ratio was 48%. So $1.20 was 48% of $2.50, and the return on new investments is 5.6%, which was providing the company with an expected growth rate in dividends of 1 minus 48% times 5.6%, 2.91%. So the initial price, so the price of the company with the initial dividend policy was $1.20 divided by 9.6% minus 2.91%. So $17.94. Now, with the new dividend policy, so the payout ratio is now 24% instead of 48% because the dividend is cut in half. So 60 cents out of $2.50 is 24%. Return on new investment remains 5.6%. So that gives an expected growth rate of 4.26%. So the price of the stock of the company with the new dividend policy is $11.23. So the new dividend policy reduces the stock price. Okay, so initial stock price 17.94. So with a dividend of $1.20 and 2.9% growth rate, stock price of 17.94. Now we reduce the dividend by 50%, which increases growth to 4.26%, but that overall reduces. The impact of the reduction in dividend is much larger on the stock price than the impact of the increase in growth. So this reduces the stock price. Another example, so a company expects earnings per share of $5 on which it plans to pay a dividend of $2.50. So a payout ratio of 50%. The new projects are expected to return 11.8%. The company plans to cut its dividend to $1.20 instead of $2.50 to invest the rest of the earnings into projects returning 11.8%. And the company's cost of equity capital is 11.7%. What is the impact of the change in dividend policy on the company's stock price? So with the initial payout ratio of 50%, the expected growth rate was 5.9%, and with a coming dividend of $2.50, this was yielding a stock price of $43.10. If the dividend is cut to $1.20 to be reinvested in projects returning 11.8%, the expected growth rate is now 8.97% for a new stock price of $43.92. So in this example, the new dividend policy increases the stock price. Okay, so what conditions must be present for a change in dividend policy to increase the stock price? So given the coming year's earnings of E1, the price and the cost of equity capital RE and return on new investments RN. So the company's dividend policy P generates a stock price given by P0 is equal to the payout times E1 divided by the cost of equity capital minus the growth rate. The growth rate is 1 minus the payout ratio times the return on new investments. If I take the derivative of the stock price over a change in the payout ratio, so we obtain this equation. So the condition for the price going up when we the condition for the price going up when we increase the payout ratio is that the return of equity capital be larger than the return on new projects. So if the return demanded by stock investors is larger than the projects available to the firm, paying more dividends will increase the stock price. If the return demanded by stock investors is smaller than the return on new projects, paying more dividends reduces the stock price. So this is simple. So we have investors here with, for example, a desired return of 12%. If what the company can do with its money is less than 12%, if the new projects available to the company provide returns of, say, 9%, investors prefer receiving the money as dividends so that they can invest these dividends in other stocks also returning 12%. If the company retains some of its earnings to realize returns of 9%, so these returns are below the 12% demanded by investors, so this reduces the stock price. If instead companies has access to projects providing returns of 15%, which is more than the 12% demanded by stock investors, well, in this case, stock investors will prefer that the company invest in its own projects, because what they can do with the dividends they receive is to obtain a return of 12%. But the company can obtain 15% on its own projects. So reinvesting in the company increases the stock price when the company's projects provide a larger return than the return demanded by its stock investors. Okay, again, we can rearrange the stock price in the dividend growth model equation to have an equivalence with the PE ratio. Okay, so P0 over E1, that's the forward price earnings ratio. So if we know the payout ratio, the expected growth rate, and the equity cost of capital, so we can find an equilibrium forward price earnings ratio. Now, if we want to compute the trailing price earnings ratio, so the price over actual earnings, well, actual earnings are smaller than future earnings by an amount 1 plus G. So the trailing price earnings ratio is equal to 1 plus G times the forward price earnings ratio. And then we will move on to changing growth rate.